This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone. Welcome back to my channel. If you've been following international news lately, all eyes are likely focused on the Strait of Hormuz. As the throat of global oil transportation, even the slightest rustle in the wind there causes crude oil volatility to spike, instantly making the market tense. In today's video, let's talk about Canadian energy covered call ETFs. I won't waste your time with fluff. Let's go straight to the hard data pulled from my proprietary analysis tool. With dividend reinvestment or DRIP enabled, we compared several mainstream high-yield energy ETFs on the market. First, take a look at the screen. These two are currently in the top tier, showing the best performance. ENCL from Global X, with a total return reaching 38.61%. OILY from Evolve, following closely behind with a return of 36.96%. As for the others, like HPF from Havest at 33.31%, NRGY from 9 at 33.68%, NXF from CI at 32.97%, or EMAX from Hamilton at 31.18%. While they performed okay, ENCL and OILY have clearly delivered significant alpha compared to them. So today, we are going to focus our fire and deeply deconstruct these two specific ETFs. First, let me explain why I want to focus on these two. Beyond being the best performers, they both share a killer feature: 25% leverage, and they are both strictly index-based. The other ETFs, while they have their own merits, always seem to be missing something. For example, Harvest's HPF. Its portfolio is globally configured with 20 holdings, doing a great job in geographic and sector diversification. It performs okay, but unfortunately, it lacks that 25% leverage, which causes it to underperform ENCL in a rising market. That's a bit of a pity. 9 points NRGI. The performance is decent, but it also has no leverage and is actively managed on stock picking, which is a different logic from being index-based. CICE NXF. Because it uses quarterly dividend distributions, its attraction for friends seeking consistent cash flow is slightly lower, so we'll pass on that for now. EMAX. It actually performs quite well, but again, it lacks the 25% leverage and the self-elimination mechanism that comes with a transparent index. So, ENCL and OILY are effectively the two products that best combine index self-evolution with appropriate leverage. Let's take a deeper look at the current frontrunner ENCL. According to the data from my tool, ENCL was launched by Global X, formerly Horizons, in 2023. Its management fee is 0.85%, and its assets under management, or AUM, has already reached $310 million, showing very stable scale. Look at the dividend profile. The TTM yield is 13.69%, and the forward yield is around 13.73%. Crucially, it pays out monthly, which is very friendly for those chasing passive income. Now, look at the performance metrics. Since inception, ENCL's compound annual growth rate has reached 24.51% in DRIP mode. If you had held this since it first launched and reinvested every dividend, your total return today would be as high as 71.11%. From a short-term perspective, its momentum is also very strong, up 22.27% in the last 6 months, and even year-to-date performance, it's up 16.98%. Looking at these hardcore stats, you'll find the reason for its lead. It builds on the already good performance of crude oil stocks, amplifies returns through 25% leverage, and uses the index mechanism to regularly keep the strong and discard the weak. Of course, if you are a risk-averse investor, seeing its max drawdown of -27.74% might make your heart race. That is the characteristic of the energy sector, high yields, but the volatility is no joke. To study ENCL, you must look at its soul, the index it tracks, the MYRI Asset Equal Weight Canadian Oil and Gas Index. A few key points from the index fact sheet determine ENCL's performance. First, the equal weight logic. Typical energy indices are market cap weighted, meaning giants like CNQ or Suncor take up the lion's share. But this index is equalized. Whether you are the industry leader or the runner-up, your weight in the portfolio is basically the same. This means when mid-cap energy stocks break out, the equal weight index captures a stronger rally without being dragged down by a few sluggish elephant companies. Second, the extremely lean holdings of only 12 stocks. While some ETFs buy dozens of stocks, this index precisely locks into the 12 most core and liquid targets in the Canadian oil and gas industry. This explains why it wins. It doesn't do group meals, it only selects elite forces, and with that 25% leverage, the power of this precision strike, becomes obvious when the market is good. To see ENCL's performance clearly, I pulled up another global X product, NRGY, for comparison. Both track the exact same 12 equal weight stocks. The only difference is NRGY is a pure index fund with no leverage and no covered calls. ENCL has 25% leverage plus a covered call strategy. Look at the results. NRGY without leverage had a total return of 43.39%, while ENCL with leverage was 41.54%. We can see that with the 25% leverage, ENCL is able to track NRGY quite well. Although oil prices have surged recently, ENCL's covered call strategy didn't completely lock out its upside. This leads us to ENCL's covered call strategy. While global X products typically covered call coverage is up to 50% of the portfolio, but this is decided by volatility. If the asset's volatility is high enough, the coverage is relatively lower. Since energy stocks are inherently high volatility asset, ENCL's coverage is usually far below 50%, typically around 35% to 40%, and the moneyness is relatively far out, preserving a certain amount of room for price appreciation. Now that we've talked about ENCL, let's look at the one following closely behind OILY. According to the data, OILY was launched by Evolve in 2025. Its management fee is 0.6%, which is lower than ENCL's 0.85%. Currently, OILY's TTM yield is 13.21%, and the forward yield is also around 13.21%. Let's focus on OILY's ability to track its underlying index, the Solactive Canada Energy Top 10 Index. My performance metrics show OILY's year-to-date performance total return reached 28.41%, compared to the official index's year-to-date performance of 27.55%. This shows OILY can track its underlying index very precisely. This is thanks to Evolve's efficient covered call strategy and its strict 33% coverage cap. The 25% leverage basically offsets the upside limitation brought by the covered calls perfectly. In terms of holdings, OILY and ENCL actually have massive overlap. Looking at these two lists, the conclusion is straightforward. They are largely the same. Most of the holdings are identical. Whether it's ENCL or OILY, they are buying the pillars of the Canadian energy industry like CNQ, Suncor, Cenovus, and Enbridge. In this sector, the number of companies with enough scale and liquidity to make it into an index is really just those dozen or so. So why do we still compare them? It's really about that final 10% to 20% of subtle differences. ENCL includes mid-caps like Whitecap, bringing the count to 12. OILY leans towards subtraction, keeping only the 10 absolute giants. In actual testing, the experience of holding these two is very similar. ENCL's 2% lead isn't so much a victory of strategy, but rather the result of those two mid-caps being more active recently. For a veteran investor, holding ENCL and OILY is essentially holding a nearly identical equal-weight Canadian energy portfolio. You are buying the same core energy giants. It's just a choice between 12 stocks or 10. The slight performance difference is simply because those 12 stocks provided a bit more alpha in certain phases. After analyzing all this data, let's get down to brass tacks. Between ENCL and OILY, which one should you choose? Honestly, it's a very subjective choice. If you value backtested performance and liquidity, ENCL is the undisputed choice right now. Its stellar total return has proven the strategy's success, and as a large fund with $300 million, the better liquidity helps reduce unnecessary slippage or premiums during trading. But personally, I actually lean more towards OILY. Although its total return is currently slightly lower than ENCL, as we just deconstructed, this is mostly due to the minor generational gap from the slight difference of holdings in the underlying index. In terms of index tracking efficiency, OILY performs excellently. Evolve's covered call strategy is extremely efficient, especially that maximum 33% covered call coverage, which preserves slightly more upside potential during an energy bull run. Beyond these technical indicators, I want to introduce a point that income investors value the most: consistency of distributions. As we all know, the energy sector is a classic high-volatility cyclical sector. While the general trend is upward, the price fluctuations are violent. For most energy ETFs, including ENCL, the distribution level usually follows the NAV. If the NAV drops, the dividend shrinks. While this matching dividends to NAV approach is very responsible and follows normal financial logic, but for investors who rely on distribution to live, this psychological experience of uncertainty isn't great. And Evolve is famous in the industry for distribution consistency. If you observe Evolve's products, you'll find they barely cut their distributions. While it's hard for them to raise distributions easily, once they set a standard, they won't lower them easily neither. This stability-first payout style is a rare and valuable experience for those who need cash flow to cover living expenses. Looking at OILY's structure, 25% leverage, 33% covered call coverage, and a yield around 14%, the basic architecture of this ETF is actually very solid. I am not worried about its long-term performance. If you are looking for a cash flow experience that is as stable as a salary with less fluctuation, OILY's payout discipline might suit your taste better. The data and logic are all here. I hope this deep comparison helps you find the cash flow machine that suits you best. If you are interested in the real-time distribution data or NAV trends of these two ETFs, feel free to visit my website at oldfish.ca to run the backtest yourself. I'm Oldfish. If you like my video, please like, comment, and subscribe. I'll see you in the next one.